to Max Healthcare Institute Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you.
Thank you. Good evening, everyone, and thank you for joining us on Max Healthcare's Q4 and FY24 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director, Mr. Yogesh Sareen, Senior Director and Chief Financial Officer, and Mr. Keshav Gupta, Senior Director, Growth, M&A and Business Planning of the company. We will begin the call with opening remarks from the management, following which we'll have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
A very good afternoon to everyone and a warm welcome to Max Healthcare's earnings call for the last quarter of fiscal 2024. This has been yet another noteworthy year for us. We witnessed a robust growth in revenue and profitability. This is our 14th consecutive quarter of year-on-year growth. The new hospitals have added rupees 42 crores of revenue and rupees 3 crores of EBITDA and a net loss of rupees 11 crores during Q4, including one-time transaction expenses. Consequently, overall network gross revenue stood at 1,890 crores, registering a growth of 15% year-on-year and 6% quarter-on-quarter. While network operating EBITDA was rupees 503 crores, a growth of 15% year-on-year and 7% quarter-on-quarter. Profit after tax dipped marginally to rupees 311 crores compared to rupees 320 crores in Q4 last year due to increase in effective tax rate having an impact of rupees 31 crores, net loss from the new hospitals of rupees 11 crores, and movement in non-cash items of fair value of contingent consideration of rupees 25 crores, which reflects improved projected profitability for the managed hospitals. Growth numbers from here on are being shared on a like-for-like basis, excluding new hospitals. Average occupancy for the network was 75%. Occupied bed days rose marginally by around 1% year-on-year and 3% quarter-on-quarter, driven largely by increased admissions under preferred channels, which is cash, TPA, and international. Growth in occupancy and footfalls was impacted due to capacity constraints. Average revenue per occupied bed, ARPOB, for the quarter improved to rupees 78,100, growing by 10% year-on-year and 2% quarter-on-quarter. Year-on-year growth was driven by increased share of super specialties such as oncology, neurology, and cardiac sciences, an increase in tariff, including that for the institutional segment. Institutional bed share was 29.1% compared to 29.2% last year and 29.5% in the previous quarter. However, after excluding Max Shalimar Bagh, the overall institutional bed share stood at 27% during Q4, and occupied bed days were down by 6% year-on-year for the segment. Network gross revenue was rupees 847 crores compared to 1,637 crores in Q4 last year and rupees 1,779 crores in the previous quarter. This reflects an increase of 13% year-on-year and 4% quarter-on-quarter. The international patient revenue grew by 14% year-on-year, slightly subdued due to credit risk-related actions taken by us and visa-related issues in 2 markets. Network operating EBITDA touched the magic mark of rupees 500 crores, reflecting a growth of 14% year-on-year and 6% quarter-on-quarter. Most importantly, annualized EBITDA per bed rose to our highest ever of rupees 78.5 lakhs, clocking a growth of 12% year-on-year and 4% quarter-on-quarter, while operating EBITDA margin stood at 28.4% for the quarter. Year-on-year growth in EBITDA was impacted due to cost of people hired for Dwarka Hospital, GST on variable management fee, and higher provisioning due to build-up of accounts receivable. Max Shalimar Bagh, where we added 122 beds, recorded year-on-year growth of 33% and 48% in its revenue and EBITDA, respectively, with an average occupancy of 78%. Profit after tax was rupees 322 crores versus similar level in Q4 last year and rupees 338 crores in the previous quarter. Free cash flow from operations generated this quarter amounted to rupees 412 crores. Of this, rupees 176 crores was deployed towards the ongoing capacity expansion projects and rupees 1,509 crores was spent for recent acquisitions. Consequently, net cash position stood at rupees 22 crores at the end of March 2024 compared to 733 crores same time last year. Continuing our efforts to support the local communities, we treated approximately 35,200 patients in OPD and 1,200 patients in IPD from economically weaker sections of society entirely free of cost. Both our strategic business units continue to report significant growth in their revenue and profitability. Max at Home reported a top line of rupees 46 crores, reflecting a strong growth of 25% year-on-year and 3% quarter-on-quarter. This SBU continues to garner customer loyalty and has now expanded its footprint to over 10 cities. Max Laboratories, Max Lab, the non-captive pathology vertical, now offers its services in 41 cities and has a network of over 1,100 collection centers and active partners. This SBU reported a gross revenue of rupees 39 crores, reflecting a growth of 26% year-on-year and 15% quarter-on-quarter. On the status of expansion projects, for 300 beds at Dwarka, we are awaiting last few licenses and will be ready to launch the hospital by early June. We expect to launch it by early June. We have already onboarded over 280 people, including senior doctors. For 329 beds at Nanavati, the hospital structure should be up by mid-July and the project is on schedule with expected completion by Q4FY24. 375 beds at Max Smart at the Saket complex. Post the initial delay due to tree transplantation issues, this project has now been fast-tracked and is expected to be completed by Q1 FY26, 9 months ahead of the previously communicated timelines. For 155 beds at Mohali, the slab work for the 3 basements is underway and base raft has been completed in May. The number of beds has reduced due to change in configuration and requirement to build a fire ramp, which is a new requirement as per Punjab fire authorities. Project completion is expected by Q1 FY26. For 300 beds at Sector 56 Gurgaon, slab work for the 3 basements is in progress. The pace of work at the project has slowed down due to restricted working hours in view of adjoining residential complexes. This will likely impact the project timeline by a maximum of 6 months. For 250 beds at Patparganj, fire and water departments have issued NOCs for the building plans, while the EC and municipal corporation approvals are in process. Tendering work has been initiated. We expect it to be on schedule. For 300 beds at Max Vikrant at Saket complex, the environmental clearance and the consent to establish have been received. Tendering work has been initiated. For Nagpur Hospital, work has been initiated to add 25 beds through internal reconfiguration by Q3 FY25, while we are simultaneously firming up plans to augment infrastructure by another 140 beds. For Lucknow Hospital, we have commenced work for installing additional 140 beds and refurbishing existing 250 beds by December 2024. We plan to add another 140 beds by Q2 FY26 subject to requisite approvals. Further 50 beds will be added through internal configuration in FY26. In addition, we plan to put up a new tower of 350 beds by Q1 FY27. Finally, moving on to overall performance, including new hospitals for the 12 months ended March 31, 2024. Network gross revenue stood at 7,215 crores, including new hospitals, reflecting a growth of 16% year-on-year. Network operating EBITDA grew by 17% year-on-year to 1,907 crores, including rupees 3 crores from new hospitals. Increased ARPOB, improved case mix, and augmentation of network bed capacity translated into a 13% improvement in EBITDA per bed to rupees 74 lakhs. During the fiscal year, we generated 1,336 crores of free cash flows from operations after interest, tax, working capital changes, and routine capital expenditure, of which rupees 441 crores has been deployed towards ongoing expansion projects. Rupees 97 crores was distributed as dividend, and rupees 1,509 crores was spent for recent acquisitions. With this, I would like to open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take a first question from the line of Tushar Manudhane from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. Sir, firstly on Lucknow, where we already have acquired...
Tushar, I'm sorry, can you use your handset mode, please? Your audio is not very clear.
Is this better?
Yes.
Okay. Sir, firstly on Lucknow, where we have acquired Sahara, where we also plan to add 140 beds and then another tower of 60 beds. So, if you could just explain conceptually the need for this buying land at Shahid Path, Lucknow. That is my first question.
Okay, firstly, the size of UP itself is the size of Europe, and it is extremely underserved market. It has a major supply of clinical talent, okay, because traditionally you had many government hospitals and many sort of this thing was well over there. It drains a lot of patients from various places, right up from Bihar to right up to Nepal and so on. We believe that there is immense need for quality infrastructure over there, and our presence in the Lucknow market, in the UP market, furthering our presence over there will add to further volumes. I mean, we've barely been there since the 9th of March, and in the last couple of months itself, we moved the capacity occupancy by 8%. Just our presence right now is taken up from 54 to 62%. So that's the extent of ramp up that we expect. Having said that, I would also like to tell you that our capacity, our infrastructure is AAA plus over there. It is right in the heart of Lucknow. If you're familiar with Lucknow, this is in the heart of Gomti Nagar, 27 acres of land, and with access like no other. In terms of infrastructure, it is superior. In terms of location, it is superior to anything else over there. And we are seeing, we believe there will be a lot of traction. The state of UP itself is the kind of development which is happening. You just see the 5 airports which have been launched, another 4 over there which are being launched, the development which is happening, aiming to be a $1 trillion economy by 2027. Now, it's another matter whether they do it by 27 or 28 or 29. But the rate of development over there is second to none. Not second to none, but it's right up there. So, for development of any state, any economy, the quality healthcare is a prerequisite. I think, there is a lot more demand over there. Yeah.
Understood, sir. Sir, but just that we could have spread across maybe other city of Lucknow, because peers are also trying to at least build a 500-bedded hospital, if not in Lucknow, but in other smaller cities. So that can sort of, reduce the pace of patient flow to Lucknow. And they are also coming up with super specialty hospital at side. So from that perspective,
please understand the demand is there across the country, right? The supply of clinicians is where the problem is. Lucknow is where the clinicians reside. That is where the government hospitals, the medical colleges, etc. have traditionally been. Now, my belief is, as far as tertiary care is concerned, okay, the entire tertiary care of the region will be serviced through Lucknow. You cannot set up tertiary care hospitals in tier 3 cities over there and in smaller cities because, doctors aren't willing to go there and stay there because the social infrastructure isn't there, the school isn't there, and so on. And given the kind of roads which are being made, the connectivity which is there, and so on and so forth, it will act like what Delhi is in NCR. You get people from various places. Now you will have Lucknow, you'll have many more hospitals over there. For that entire state of 280 million people, literally, there are 1.5 corporate hospitals and both of them are in Lucknow. You haven't heard of a third hospital in all of UP, right? My belief is you can have 5 more super specialty hospitals. Why 1 or 2 more? The only question that I needed to ask at that point in time when we were even bidding for this piece of land is, look, okay, does it deserve another super specialty hospital? What if somebody else gets it? And so on and so forth. I think, like in Delhi, our approach is a cluster approach. We believe that is the next Delhi NCR. And frankly, it can do with many more hospitals.
Got you, sir. That's helpful. And secondly, with these beds sort of coming up, and just to refresh per se, in terms of the EBITDA growth for say 25-26, with the kind of expenses that will be coming on board, particularly for FY26. So if you could share in terms of whether we'll be able to grow on the EBITDA front even in 26.
You're talking about 26 or 25 now?
26, sir. FY26 particularly.
Look, so imagine what's happening into FY26, right? You would have Dwarka, which starts now in the first this thing of June. Okay, we break even by the end of the year. Okay, next year you're definitely in the black and making money. You put all the building blocks of Lucknow and Nagpur in place. Both of them are profitable in any case. Okay, they become more profitable in 25. But look, it will have a tremendous growth in 26 simply because this year we'll be fixing everything and so on and so forth. Then you have 3 basically capacities coming in beginning of FY26 effectively, which you will get the benefit of the whole year. Will be Mohali, 155 beds, 329 beds in Nanavati, and 375 beds in Max Saket. All 3 are brownfields. Right in the adjacent to properties which are already fully occupied. You should see the same sort of results that you've seen in any of our brownfields. FY26 will be a very exciting year for us, in fact. I think this year, if you look at FY24, it was always meant to be a year of incremental growth. We are very fortunate we were able to add. In fact, 25 would have also been incremental growth if we hadn't added, both Lucknow and Nagpur. We'll have the EBITDAs and the revenues kicking in from both these. You add to it Dwarka, where you will have some losses, of course, up till break-even in the first year, okay, which will get more than absorbed by Lucknow and Nagpur. But next year, all 3 will be exploding. And in addition to that, you have 3 brownfields, okay, which don't take time to break even. Have you seen that in the past?
Understood, sir. That's helpful. And just lastly, what made a push or in fact prepone the Max Mart by almost 9 months? If you could just elaborate on that, that's my last question.
So, as you're aware, we were coming up with a much larger capacity in 2 phases in Max Mart, and we were also coming up with the first phase of Max Vikrant capacity. Now the fact is that we got delayed on Max Mart, so what we've done is instead of doing 1 phase of Max Vikrant, which is contiguous, which is adjoining on adjoining land, and doing 2 phases of Max Mart, we are doing 1 phase of Max Mart and 2 phases of Vikrant. So what we've done is essentially we preponed. We are not going to be making so many basements. That takes less time. And, we preponed the entire project. We'd rather have 375 beds sooner than have 600 beds later and then another 300 beds coming through Vikrant at an even later stage. Right now, we kind of caught up with Vikrant timeline, which was supposed to be later, and that's how we've done this.
Tushar, does that answer your question? Thank you. Ladies and gentlemen.
I'd like to add, so this should be a surprise to everybody. It's a pleasant surprise that we've been able to prepone Max Smart. I think a lot of people are expecting delays, let alone delays. We've preponed this entire project.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. We'll take our next question from the line of Damayanti Kerai from HSBC. Please go ahead.
Hi, good evening, and thank you for the opportunity. Where you mentioned in your opening comment, there were some visa issues in 2 markets, which slightly impacted the international segment, international patient segment. Can you please elaborate on it?
So, Devanti, basically, there are, markets of Iraq, etc., where we have AR built up. So we obviously took some calls on the trade control, and we said we will not take more patients till such time we get our money. So I think that's what I was alluding to. There are also some markets where there's some disturbance on the visa side, right? So because of elections, the visa, etc., were not being given, right? So these are the 2-3 markets that got impacted, right? So you'll find that overall we've been growing the international market by international revenues by around 23%. This quarter it is 14-15% growth. So bit subdued growth because of these 2-3 reasons.
Okay, and these are more temporary in nature, right? And once
yes, very much.
Okay.
Okay.
We continue to see great traction with new offices that we are opening overseas. It's very, very positive, and we intend to sort of double down on that further.
Okay, so in all focus market, you will be doubling down your effort to get more footfall.
We started the direct-to-fly kind of setting up offices, okay, as you recall last year. And we've seen great traction with that and great throughput through those. So we're seeing a lot of success through these new markets where we're setting up our own offices. So we will continue the strategy.
Okay. And the way you mentioned attractiveness of Lucknow market in terms of like demand and then availability of clinical talent, etc. Can you talk a bit about how do you see the Nagpur market, and do we have similar supply of clinical talent in that market too?
Yeah, so I mean, you have supply of clinical talent, but if I look at the country if I look at India, Lucknow that way is unique. Perhaps it has the most amount of, and just to give you an example, a lot of at least 20% odd of our own doctors in Delhi, which work for Max have come from Lucknow. So it's traditionally been this thing. Of course, Nagpur is also a repository for clinical talent, but not to the same extent in Lucknow. Because Lucknow is Lucknow. You don't have other places the same sort of this thing. I mean, I would compare Nagpur more to a Dehradun and where we have hospitals which are doing quite well, etc. But I would compare it to those markets rather than. Having said that, it is emerging as the transplant capital of the country. Because you have huge amount of awareness of organ donation, and lot of people, it seems to be a cultural thing, they are donating organs and so on. Also, it is been a big thing for mouth cancer because of much higher consumption of gutka and so on and so forth. So we are seeing a lot of oncology patients in Nagpur. So I think oncology being our mainstay, I have no doubt that so let me also clarify. Nagpur also has much fewer sort of quality healthcare assets. I don't think there is anybody even compared to Alexis over there. Competition is also significantly lesser. So we will have first dibs to pretty much all the clinical talent over there. So we are quite comfortable that maybe less than Lucknow, but nevertheless we'll get the best dibs. So we don't have a challenge getting the clinical talent. And the market itself is quite big. It also draws a lot from Madhya Pradesh, Chhindwara and so on and so forth.
Okay.
And of course, being this country state, it also has great connectivity and infrastructure.
Okay, and my next question is a quick clarification on occupancy. So now you're giving it on like-for-like basis, 75% for fourth quarter, and then you have given separate number for the new units. Can you just for understanding purpose, on a blended basis, what is the number, occupancy number for fourth quarter?
to be around 73%.
Yeah. 73, but do keep in mind that Nagpur has only been there since 9th of February, and Lucknow has been there since 7th of March. So you don't get the full import of the fourth quarter, right?
Got it. And my last question is, like your upcoming hospitals, most of which are located in very attractive location, brownfield location, etc. So for most, I guess we are assuming break even within a year of start of the operation. So very broadly, like what kind of loss you generally incur when hospitals are ramping up, maybe like loss per month or any indication?
Hello?
Hello?
In the brownfield?
For your upcoming hospitals, most of which are brownfield. So I just want to understand, while hospitals are ramping up, what kind of loss you generally incur?
So I'll give you the example of the last brownfield we did.
Mm-hmm.
We added about 122 beds on, I think, 240 or 250 beds. That would have broken even in 10 days or maybe 15 days. And by the 40th day, the additional beds were generating a 40% EBITDA margin. And in the whole year, I think we have a 78% average occupancy of the new and the old beds. So brownfields don't take time to break even. They don't take years, they take a month. We normally say a quarter at best, but we've kind of outbeaten that every time.
Yeah, just like in NCR, I can understand this kind of performance we may expect. But is it true for, say, Nanavati or Mohali, etc. also? We should see similar ramp up?
No doubt. I mean, Nanavati is Bombay, right? I mean, in the heart of Bombay, you have another 375 beds of quality beds coming in. And in a place where no new hospitals come up in 20 years, I don't see a challenge in breaking even. And Mohali, again, it's the highest ROC, the highest occupancy that we have in the country right now is in Mohali Hospital. It's not Delhi and Bombay.
Okay. Thank you, Ben. Thanks for your response.
No trouble with Mohali.
Thank you. We'll take a next question from the line of Neha Manpuria from Bank of America. Please go ahead.
Yeah, thanks for taking my question. Given the background you gave on Lucknow, is it fair to assume that Lucknow can get to what we have margins for our corporate average, much faster, probably, let's say, in 26 itself? Would that be a fair assumption, or do you think because of the addition, etc., that could take a little bit longer?
See, addition is a separate thing altogether. Addition is a capital expenditure, right? I mean, the margins are always
associated with the addition, etc.
I didn't get the question. Can you repeat the question?
They are basically, in terms of margin, we can probably get to the overall, similar kind of margin very soon. Not probably, in the initial part of the year, but maybe by the end of the year. But I think the EBITDA per bed will have to wait because I think the ARPOB there is low, right? So the ARPOB in Sahara Hospital when we took it was 40. So I think the ARPOB has to go up, right? The margin on the lower ARPOB doesn't really mean much because we generally see that in EBITDA per bed metric, right? So EBITDA per bed will have to wait. I would say it will take some time to get to the level. But margin by probably the end of the year, we should be closer to what the margins are, on an overall basis.
I think on pretty much all ARPOB and other matrices, I think we will be able to catch up in the next 2 years. When I say catch up, you know the numbers of some of our peers over there. So I think we should be able to get there, if not further.
Oh, okay, understood. And what about Lucknow, sir? Given the margins there, at least the numbers that you gave seem, close to 14-15%, and it's probably not as flourishing as UP. Would that take a little bit longer and a much slower pace to?
Nagpur or Lucknow?
Lucknow.
You mean Nagpur? No, so Nagpur is a different ARPOB. See, please understand, different ARPOB means different ROC as well. I mean, today, in Mohali and Dehradun, okay, you compare it to similar to a Dehradun rather than any other sort of this thing. I mean, you can't compare ARPOBs of that to Delhi and Bombay for that matter. You'll be looking at obviously more subdued ARPOBs, but given the price you pay, you look at ROCs.
So if I were to look at the, Nagpur, ARPOB, it's very similar to where Lucknow is, right? So that's why I was asking. So will it take the same trajectory as Lucknow? Could that be
Today it is, but Lucknow has a potential a lot more, right?
Yeah.
Like I said, Lucknow, we will if we even look at some of our peers who are operating there, they operate at a significantly higher ARPOB, correct?
Yeah.
Nagpur as a market will, you can use maybe Dehradun as a surrogate.
Oh, okay. Understood. Got it. Okay. And in terms of, incremental M&A, now that you've announced this in land in Lucknow, you've always said we'd rather be, the second or third player in a market. Any markets that you think are interesting, particularly, given you've done two of these, Nagpur and Lucknow now, which could interest you?
There are 20 cities where at least two people or three of my have proven viability and doing fairly well. We intend to go there if we find the right targets, and we are quite confident we'll be able to perform better than them.
And Abhay, what would be our target leverage? I mean, let's say if we were to get a multiple, assets, what leverage are you comfortable with in terms of when we're looking at M&A? Particularly given the strong cash flow generation.
Yeah, so we are quite comfortable with going up to 2.5 times debt to EBITDA, right? So if you actually see our EBITDA at present, I think we will be circa 2,000 crores. Okay, you have 1,907, but if I add up, 11 months of EBITDA for both Nagpur and Lucknow, okay, you'll be closer to 2,000 and plus, right? And then you have growth in the current year. But even if you take 2.5 times that, you're getting some 6,000-7,000 crores of debt that we can use. Now, do keep in mind, anything bigger than that would mean that we are acquiring something which is listed. And if it's a listed entity, in any case, you'll have to look at a merger, because you can't have a step-down subsidiary of a listed company to be a listed company.
Yeah. Understood. Fair enough. This is helpful. Thank you so much.
Thank you. We have a next question from the line of Andre Purushottam from Cogito. Please go ahead.
Thank you. I have two questions.
So may I request you to use your handset mode, please? Your audio is not very clear.
Can you hear me now?
A little better.
Yeah. Okay. I have two questions. One was, could you comment on the valuation parameters and in acquiring these two hospitals? They are at two different EBITDA multiples. Are they meant to be ROC accretive, or what is the philosophy, financial philosophy, apart from growth, obviously? That is the first question. And my second question is that going forward in the next 12 months, how do you see the levers for profits working in your favor? Whether it is increasing mix of international patients, whether it is a better mix, whether it is a lower proportion of government cases, etc., etc. I just wanted to hear your general outlook on the trends that you see in the next 12 months that will lead to profitable growth.
I think two aspects. One is on the financial aspect. We seek a 20 to 25% pre-tax ROC, within a space of 4 to 5 years. In both these cases, my belief is we will be able to hit that number far sooner than that. And we do this by seeing what is the value we are paying versus what we believe with adequate amount of intellectual integrity. What is the business plan that we are able to or capable of underwriting? And so you do a goal seek for that number at 20-25% pre-tax ROC, and that's how we come up with the maximum that we are willing to pay for asset. Of course, we don't pay that maximum. We try to negotiate and pay as little as possible, but that's where we are on the financial side.
Right.
I hope that answers the question as far as what is the fiscal target. Now, as far as drivers for the current year is concerned, I think it is all of the things that you spoke about. Sorry?
So the next 12 months, right?
Next 12 months is this financial year, right, effectively?
Yeah, okay.
You will decide of the next financial year. If you take instead of 12 months, I'll just draw a line at 10 months or whatever, because that's the number of months left for the current financial year. I think all of these that you mentioned, I think higher international patients, So that means better payer mix, a better clinical mix. We are seeing more robotics happening. We are seeing more sort of this thing on oncology, higher end surgeries and so on and so forth. So I think all of these things should be in play. We are also hoping that, and we believe that, CGHS rates will get reworked, and even on the institutional side, we are expecting better rates. So I think all of these are levers for us in the current year. Other than that, of course, compared to last year, we would be adding the EBITDA or an incremental EBITDA emanating from both Lucknow and Nagpur, whilst Dwarka will have some sort of initial losses at startup. But those initial losses at startup should be, we'll be able to more than absorb it with our new profits that we're generating through Lucknow and Nagpur.
Right. And due to the drags on profitability?
No. Like I said, of course Dwarka will take time to break even, but we've added 2 new capacities, which is 500 beds, which are already generating profits and free cash flows. We will be adding to that. That number is only likely to go up under our watch.
Okay. Thank you. Thank you very much.
Thank you. We'll take our next question from the line of Binu Patiparampil from Elara Securities. Please go ahead.
Hi, good afternoon. Just 2 clarifications. One, did you say you're planning to add more beds in Nagpur over and above the 200 that's there?
That's right. We're going to add another 150 beds on top of the 200 beds that we have.
By when would that be?
I think, we are working that out at present, but definitely within the next 24 months. I think we've given a timeline. So I think definitely within the next 24 months.
24 months, okay. And I didn't quite understand the Saket Smart and Saket Vikrant. So both put together, how many beds are now getting added in FY26?
No, Vikrant, nothing is getting added by 26. Saket is getting added by 26. Vikrant wasn't meant to be added by 26. Vikrant doesn't come in play, whereas Saket, which was going to be added in 27, has been preponed by 9 months, is going to come through in Q1 FY26.
That is 350 beds?
375 beds.
375.
Sorry?
375 beds.
375. Okay. I was looking at your Feb investor presentation. That shows Vikrant 300 beds in FY26. Is that old one?
I don't know. I think maybe you're looking at the older presentation. Which presentation are you looking at, Yogesh?
No, so I think the investor pension we have to change for all these 375 bed changes that I'm doing. I think that will be updated now with whatever we've done in terms of preponing the beds, right? So there are some beds being preponed, some being kind of postponed. So I would say this presentation will get updated in another week's time, the new one. And that is the one that should be referred, right? So because as I mentioned, we've done some resetting in terms of, getting some beds in advance. And some beds are getting delayed for that reason.
Okay, understood. Thank you. I will refer to it.
Your total number of beds remain the same. But like I said, this gets preponed. Your total number of beds don't change.
Okay, thank you.
Thank you. We have our next question from the line of Rishabh Tiwari from Allegro Capital. Please go ahead.
Hi. So I have 2 questions. Firstly, what would our EBITDA look like now post-rent for this quarter and for the year?
I don't give forward-looking projections.
Sorry?
We don't provide forward-looking.
No, for this quarter and for this year, post-rent.
Rishabh, we don't provide guidances, right? So we don't generally provide guidance for the next quarter or for the year.
No, I'm asking for Q4 and FY24.
Yeah, so Q4 EBITDA was 500 crores from the existing hospitals, right? There's a 3 crore EBITDA which has come up from these, 2 hospitals that we added in quarter 4. One was in February, other was in March, right? And the 3 crore is actually net of 5 crores of expenses that happen on the deal side. So the overall EBITDA for the year is 1,907 crores.
This would be post-rent, I assume, right?
Post? Ind AS, yes.
Yeah, post. No, I'm asking post-rent. That is pre-Ind AS.
So for pre-Ind AS, you have to reduce it by around 70 crores. So that will be if we want to take the leases up, that's the only difference in our case. So the lease cost would be around 70 crores.
For the year or for the quarter?
For the year. For the year.
Okay. And next question is, Abhay, you mentioned that we took the occupancy up from 54 to 62 in Sahara Hospital. I just wanted to know more about the clutch. Was this through operational levers? Did we see some improvement in seasonal mix or something? How did we take this within few months?
No, just changing some basic processes. You always have some very, very early easy wins when you walk in, right? Because you have seen those things. Those things kick in. These are very cheap early wins.
Okay.
Like
okay.
and
are we looking to add any beds here as well in Sahara?
We will be adding beds. Like I said, we will be adding 140, then another 140, and then 350.
Okay. Okay. Thanks.
Thank you. We move on to our next question from the line of Amey Sarke from JM Financial. Please go ahead.
Yeah, thanks for taking my questions and congratulations on a good set of numbers. The first question I have on the volume growth. So IPD volume seems to be around low to mid single digit. Anything to read there or to expect the volume growth to remain at this kind of levels? And second question I have is on the city selection. I understand we generally map 20 odd cities across the country. What would be the cities you would not like to enter into, and what are the reasons for the same? Thank you.
Okay, so first and foremost, you have to keep in mind that our occupancy growth till we come up with new capacity, brownfield or otherwise, okay, will be fairly muted because we have a capacity constraint. I mean, we don't have places to put more patients, so that's why we are doing the brownfields, right? So, having said that, when we will have a constraint, because of constraint on capacity, our occupancy ramp up will be limited, whilst it will have a positive impact on ARPOBs. So what tends to happen is that the lower end surgeries get posted, okay, at a later stage, at a later date, whilst the larger surgeries, the more significant ones, okay, get priority as they should. So therefore, the lower end ones sometimes have a tendency of evaporating because the patients then decide to go to some other facility or some other brand because they may not be very important sort of surgeries as well. So what happens is that your, whilst your occupancy doesn't ramp up, your ARPOB, okay, you see a significant growth in ARPOB. But when you come up with brownfield capacity, the interplay which happens is that the occupancy ramps up immediately, but your ARPOB growth becomes more muted. Having said that, the impact on overall EBITDA per bed is positive simply because you have huge operating leverages emanating in the new capacity that you add. Because, the management costs, the clinician costs, etc., are already being incurred by the previous capacity. So I just wanted to answer that question as far as occupancy is concerned and kind of assure you that there's nothing to read into it, simply that we don't have capacity. So, our occupancy obviously will go up at a smaller sort of pace. Having said that, when you look at your second question was with respect to which cities I would not go to. So conversely, I would not go to cities where my peers have not proven viability or uncharted territories because, we don't see ourselves as pioneers going into places where, and taking chances. We'd rather have somebody else define the market, be able to sort of demonstrate success, go there and try to do it better. We've been very comfortable in doing it and we've been successful in doing that.
So is there any city which you think is oversupplied with the quality of the beds, etc., or it's just that because it's uncharted territory, that's why you don't want it?
No, so let me give you an example. Look, the maximum amount of beds, okay, in any geography is Delhi NCR, right? This is National Capital Region. We have 11 hospitals over there and we have 2,100 beds. we are the largest players by far. We are equal to our next three peers put together, multiplied by 2 in terms of number of locations, and we are equal to all three of them put together, okay, as far as number of beds are concerned. And the next 15 players have similar amount of bed locations, similar amount of bed capacity. Yet we only have 2,100 beds, 10% of which are free, 10% of which are catering to international business, 40% of which are catering to upcountry. So essentially, if the largest player has 800 beds catering to the national capital region, okay, and the next three peers of mine, okay, that you heard of, they also have 800 beds, and then the next 15 people have 800 beds, that's like 2,400 beds or 2,500 beds for a population of 48 million people, which is 85% of UK's population. And this is a place where you have the maximum water supply.
Right.
So look at the places we are going to. If we are going to Lucknow, literally, there are 1.5 corporate players. Then we've come up with a hospital, and there's a state with a population of 24 crore people, which is Europe's population. We are in Dehradun. We are pretty much the only players over there. We are hardly there's us and one more player. You look at. If some of my peers are in Patna, but they're the only players over there. If you look at places like Kanpur or Pune, this, that, etc., every place is underserved, right? Even a place like Bombay, no new hospital come up in 20 years. I don't think India, we have a problem of oversupply anywhere.
Right. But in generally speaking about the Mumbai, like we generally don't see, except I'm talking about the private hospital, we don't see hospitals being overrun or something like that. Or there is a, like we have not seen many hospitals getting added, but we have not seen capacity getting overrun.
Let me hold you there. You haven't seen hospitals being added because to make a 400-bed hospital, you need 4 acres of contiguous land. Firstly, you can't find 4 acres of contiguous land in Mumbai, and even if you found it, you'd rather make a residential complex or a commercial building there, right?
Right.
No new hospital made for 20 years. It's the same hospital, Hinduja, the same breach canteen. They haven't added 1 square inch. Where's the space? Even HN, they brought down an earlier hospital and made a new hospital, right? Bombay hospital is the same one. Jaslok is the same one. Nanavati was the only one which had the land, so they built it.
Thank you so much. I will join back. Yeah.
Thank you.
Thank you. We have our next question from the line of Kunal from Macquarie. Please go ahead.
Yeah, thank you for the opportunity, sir. Just kind of, continuing on the previous question. So mature hospital, we are at 75%, and we are saying that there is not enough capacity for us. But we have done quarters with 77-78% occupancy, right? So what is it is it a mix of hospital where, our good hospitals are already full and some of the hospitals are below that 75 run rate? And secondly, if it's kind of across the hospitals, we are facing a difficulty in terms of capacity, then why our payer mix improvement is not accelerating in terms of reducing the institutional patients?
Because, Kunal, it's a seasonal business. Okay, there are some quarters which are surgical quarters and some quarters which are medical quarters. Okay, in a medical quarter you require rooms, while surgical quarters you require more sort of ICU beds. And it's not every kind of capacity is not fungible across every hospital. In fact, some hospitals may have certain constraints that they're operating 75% because you have maybe lesser single rooms where there's demand for and more ward beds where you don't have demand for, and so on and so forth. But whereas, in a dengue season, even the lesser sort of rooms or multi-share, etc., get absorbed. And that doesn't happen in a surgical season. So that's the reason that, we are constrained by seasonality as well as the kind of infrastructure that we have. Now, as far as the payer mix is concerned, okay, the payer mix is a slow turn now. If I look at ex-Shalimar Bagh, ex-new capacity that we've come up, okay, it's come down from 29 to 27%, but there's been a 6% reduction as far as the occupied bed days are concerned. So I think what we are seeing is, we are seeing a turn, perhaps more so on the occupied bed days than anything else.
Sure. Thank you. But let's say when you say the 122 beds added in the Shalimar Bagh capacity or hospital, and we say that, it's been EBITDA positive in 10 days, is it more on a contribution margin? Because if I back calculate, our payer mix for that 122 beds, there'll be roughly 46-47% of those beds have been occupied by institutional patients, right? And we all know that the ARPOB are roughly 50% of what you get in other channels. So is it on a contribution margin we are seeing that, the EBITDA turned positive in 10 days? Was it loaded with the management cost, or how should we think about that?
Please, let me explain.
No, that's on it's an EBITDA. It's after the incremental cost that you have to, incur for those beds. So it's not contribution, it's EBITDA. Right? You have to understand that we had an option. We had an option to open only 50 beds to start with, not open all the 122 beds, right? What we did is we said we'll open all the beds and try and fill up the balance also through the institutional beds or institutional patients. So there are two options that we had. Right? So we chose for the option, we said let's open all 122 beds and then try and fill up and then filter, right? Then distill. So that's where we are today. But when we say number, the number 40% is EBITDA margin, right? After incremental cost. Including if you have 122 beds being open, there are more manpower being recruited, right? So there are nurses required, there'll be GDs required, maybe less doctors, but there'll be more electricity costs, etc. So it's after all those costs.
So even with 46% kind of institutional payer mix, we are making 40% EBITDA there. Is that the correct?
Because the incremental cost of running those beds which we open is very less, right?
Let me explain this separately. Let's say if you look at bed by bed, unit wise, right? Or let's say all 100% of the beds over there, okay, you were operating only for institutional business. It will still be EBITDA positive. Okay, it will be EBITDA positive simply because you got operating leverage. The only thing you're getting over there necessarily, okay, is the nurses, which is not very expensive, is the resident doctors, again not very expensive, okay, and allocated to those beds alone, which are operational. What you're not doing is you're not fitting out beds and you're not sort of staffing beds where you don't have capacity. You just open floor by floor, right? Whatever you have demand for. So there's no fixed cost associated or fixed variable cost associated with beds which are not operational. And the ones which are operational, we have only the low-end cost. It does not have high-end sort of clinicians, etc., or minimum guarantee which are being taken on board for that. Because those clinicians already exist, their minimum guarantee is already paid, utilities are common, the general sort of, management cost is already being incurred. You don't operate a separate CEO, separate medical director, separate HR, separate marketing, nothing for that.
Okay. Thank you for that. And if I may just, one more on the Supreme Court matter. Now it seems that the next date for that, hearing of PIL seems to be somewhere around September. So what's your internal assessment? Is it kicking the can down, or would you say that the risk of adverse outcome has reduced meaningfully in your view? How do you view that?
I would not want to comment on it. It's a Supreme Court matter. It's sub judice. Okay, we've seen the rap IMA got, so I definitely don't want to be speaking about it. But I think the last hearing, the comments, the observations of the judge, etc., were for everybody to hear and make their own inferences, please.
Sure. Thank you and all the best.
Thank you. We'll take our next question from the line of Shubham Harne from Purnartha Investment Advisors. Please go ahead.
Hi, sir. On Dwarka bat, I want to ask question. So that beds getting added in tranches, or it will be on one go?
No, in transit only. I think, because our occupancy will also have been in transit only.
Okay. So initially, earlier you have said 160 bed will be added and then 140, something like that only?
The occupancy also ramps up in that manner. No point staffing all the 300 beds whereas you don't have occupancy day one of all 300.
Got it. And on Gurugram Sector 56 hospital, by when it will get commissioned or something, some dates around that?
If we gave the date, I think, one second. I think Gurugram Sector, this thing, we delayed by 6 months. So whatever the original, this is later by 6 months. I think it will be third quarter of 26. or 25?
Q3 FY26, yes.
25, 26 or 25? 25, no?
Calendar year 25.
25 is current year.
Yeah, calendar year 25. Financial year 26.
Oh, okay, got it. Thank you, sir.
Thank you. We have our next question from the line of Rishabh Tiwari from Allegro Capital. Please go ahead.
So just one follow-up on the lease impact. So 70 crores is what you mentioned for the year. Is this taking into account the recent acquisitions? Could you please help us with the like-to-like number for
the recent acquisition doesn't have any lease rentals, right? So that land is obviously getting converted to freehold. We already put bunch in application. So this is on the existing hospitals.
Okay, that helps. Thank you.
71 crores is a total impact. There is one or more two entries right now which comes up in the below the line. So I'm taking all those. There is donation also. There is liability for donations that we have. So that also comes up. 71 crores is total impact of the India's movement. If I was to do either accounting, then the 71 will come before the EBITDA.
Okay, thank you.
I think just the last thing, I think the important one, I don't know if you picked up my statement or not, that during the fiscal year, we generated 1,336 crores of free cash flows from operations. This is after interest, tax, working capital changes and routine capex also, let alone leases. So our translation of EBITDA, post-India's EBITDA to free cash flows, post India, pre-India's impact, interest, tax, working capital changes and routine capex, etc., 70%. This is a significantly high number.
Thank you. We'll take our next question from the line of Senthil Kumar from Joindre Capital Services. Please go ahead.
Good evening. Thanks for the opportunity. My question is, what is the management policy on writing off goodwill and other intangible assets over a certain period of time as a matter of prudent accounting policies?
No, what is it?
Management policy on writing off goodwill and intangible assets.
No, so goodwill is not under the India's. The goodwill is only tested for impairment. Intangible assets represent some of these contracts that we obviously over the period of time we are writing down off, right, over the period of the contract. But there is an element of brand in the intangible which we again test for impairment, right? So the India's accounting standards require us to only test for impairment the goodwill and the brand, and for the other intangibles you will find that they are coming down progressively, year after year because we put in them in the amortization charge. Yeah.
Okay, understood. Thank you. That's it from my side.
Thank you. We'll take our next question from the line of CA Vipul Makwana from Makwana. Please go ahead.
Hi. Good evening to everyone. Good set of numbers, okay, sir. Apart from my peers...
Makwana, can you use your handset mode, please? Your audio is not very clear.
Yeah, hello. Can you hear me now?
Yes.
Yeah, apart from all the financial queries which my peers have asked, I just want to ask on the qualitative aspects, like what is Max doing separately or concisely different than the others where we're seeing a good number set, like our co-ops and everything. So, Mr. Bhai, if you could just throw some light on it.
I think first and foremost, proof of the pudding lies in its eating. The fact that we have a significantly higher occupancy levels than any of our peers or whatever means that we are doing well on qualitative aspects as well. The value proposition that we're able to provide to our patients. It's not only Delhi, Bombay. Our highest occupancies also continue to be in tier 2, tier 3 cities. So yes, I think it's for people to perceive. The patients to perceive more than what I can say, in terms of what is the quality that they this thing. Yes, we continue to cater to a lot of free patients. There are thousands of patients in a year that we treat free of cost, and I mentioned to I think 35,000 patients in OPD and some 1,500 patients in IPD in the last quarter itself that we treated. All our hospitals are teaching hospitals. We have 850 odd students, both these are postgraduate students We write a lot of, you've seen the number of publications that we're doing, which is the highest ever that we did last year, both for international and domestic journals. So we continue to academics and research as well, besides, of course, the financial parameters that we operate.
That helps. Thank you so much.
Thank you. We'll take our next question from the line of Amit T, an individual investor. Please go ahead.
My question has been answered. Thank you so much, Abhay. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to management for closing comments. Over to you.
Thank you. I would like to thank each one of you for either covering the company or having invested in the company. We appreciate that, and we believe the next 2 years will be years of exponential growth for us, particularly FY26, where a lot of things are going to be coming on stream. So we look forward to an extremely lucrative journey going forward. Thank you.
Thank you, members of the management team. On behalf of Max Healthcare Institute Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.